by the way, I put the go-to meeting link in the Teams chat for the invitation that was previously existing.
That's a great idea.
Nel profondo, un fuoco che mi accende.
Good afternoon, this is Pierre. Are we waiting on George? Oh, okay, thank you.
Hey, George, I think we're in the right place now.
Okay. And is anyone else here?
Hey, George.
Yeah. There's about 23 other people.
We're all here.
Oh, okay.
Yep, we're here.
Okay, great. Sorry for the delay. I'm not sure what it sounded like there was some sort of technological problem. So, welcome to our annual budget education training session. And first, do we have, who else is here? I see Zuby. Who else is here for? Linda? Hi, Jody, you're there. So we have a quorum. Pierre is not with us?
I'm here.
Yep,
Oh, you're there. Okay, good. We have a quorum. So could we adopt the agenda? Do I have a motion to adopt the agenda?
I move to adopt the agenda.
Okay, do I have a second?
Second.
Okay, we have a motion and a second to adopt the agenda. So we will
Aye,
immediately. Yes,
aye. Vote.
okay. All in favor?
Aye.
Aye.
Aye. Okay. Thank you. We will now go into closed session. So we have to check out of this and go into closed session.
I'll have to take roll call.
We need a motion. A
Okay,
roll call.
sorry.
Move to go to closed session for the purposes of whatever we're talking about.
Okay,
Second.
second, good. And roll call, Audrey?
Yes, roll call.
Chair Gamble,
Yes.
Vice Chair Pugh,
Here and yes.
Secretary Quintana, Member Siegel,
Yes,
Member Wilson.
Yes.
Okay. Let's do it. Okay. Do we have a quorum yet? Zuby or Pierre? We're waiting for.
I'm here, Chair.
I think everyone's here.
Okay. So could I have a motion to move back into open session?
So moved?
So second? Got a move and a second. All in favor?
Aye.
Aye. Okay, we have a motion and it's passed to go back into open session. So now I think that I will turn it over again to Nick for our budget training.
Thank you, Mr. Chair, board members, President Rowley. We normally, when we do our budget work session, we provide kind of we call it a training, but it's really an overview and a recap of how we assemble and develop the budget. And since we have a new board member, technically two, but member Siegel's been with the board many years, we'll go through this just to give the background on how everything is developed. So let me share my screen. Please let me know when you can see it.
Okay,
Okay.
we've got it.
All right. Go ahead and move through this. Let's see here. Okay. Just want to start out with what's really important in terms of building our budget is the way that we have our account code structure set up. So the FOAP is incredibly important to budget development. And we have to assemble the budget according to HED rules and the accounting structure that's in place through HED. And we deal with fund accounting that can be very complicated and make it difficult to read our reports, because what fund accounting does is we have really restricted, isolated funds that can only be used for particular purposes. But when we produce our audited financial reports and some of our other reports, it aggregates those very almost siloed funds into a higher level. And that's basically due to our generally accepted accounting principle rules that we have to do. So it creates challenges, and me and Amy always say that fund accounting is not always fun accounting, but it is what we do, that's for sure. So our budgets have to be developed, again, within those parameters of very specific funds that kind of roll up, but we also have to keep them in our rules separated between unrestricted and restricted budgets. And so the unrestricted are funds that really are for obviously operating expenses, running the college. The restricted are primarily grants for the most part. And then we'll talk about our budget cycle and budget development. So moving on, this is a little breakdown of our fund organization, account, and program code layout. And this is subject to be changing actually very soon under the new ERP and Workday. Workday does this same thing, but it does it a bit different. And we're really in the midst of changing that up a little bit. But what will really roll into the new Workday system is we'll have to keep our fund part of our account code intact, and that will identify the funding source. The org is what we reference to when we talk about our budgets under that org part of the account code. The account is actually going to be like our assets, our liabilities, our revenues and expenses, and our program code is how we report all of this to HED and keep track of our financial activity and put it in the format that we can report to HED. Activity we don't use, and location we're not really using at this point. I think in our new ERP system, we will have a way to track those two elements, but right now we don't do that within Banner. This is a different way to look at it in terms of our exhibits that we have to follow in terms of NACUBO rules that are also associated with the New Mexico Higher Education Department rules. And we'll talk here a little bit in a minute about the HED manual that we have to follow. But basically, this is the diagram of how the HED manual kind of works. Within our current funds, you see we have two categories of ING, instruction in general, and then non-ING. Those two things make up current funds, and then you can break them down even further. And ING is made up of instruction, certain expenses that are specific to instruction, expenses that are specific to academic support, student services, institutional support, and plant operation and maintenance. On the non-ING sides, where you see student social and cultural, public service, where we have kids campus and conference center and higher education center, and then our internal services that are non-ING. That's some of our chargebacks that are associated with OIT expenses and postage and maybe fleet. And those are real tricky because Exhibit 18 and internal services ultimately get charged back to ING. They get charged back to Exhibits 10 through 14. But in terms of our rules and HED, this is how it's laid out. So we account for internal services under Exhibit 18, and then 19 is financial aid, and 20 is auxiliaries, which in the past were the bookstore and food service. We also have to account for plant funds very specifically, and we keep track of our exhibit. It's really Roman numeral I, which is capital outlay. And then we have Roman numeral II, which is renewal and replacement, and Roman numeral III is debt service. That's where we account for all of our mill levies associated with revenue that pays for and is very restricted to pay back our debt service and our outstanding bonds that we have in place. Moving on, I'm going to try to go through this fairly quickly. This is a little bit more of a detail of that FOAP and how it works within Banner. And, you know, again, another way to look at it is under the fund, it's kind of, the question is asking, where does the money come from? And the answer to that question should be captured within the fund part of the FOAP. The org would be who is responsible for the money, meaning like which department would be responsible for that money. And then the account is what type of transaction is taking place. Is it are we booking revenue? Are we making an expense? And all of that. The program code is how does the transaction, and it's really, the transaction, how does it tie to the HED manual that we have in place? And so the program is critical in terms of being able to report accurately to the higher education department. Fund accounting, this is kind of what I was mentioning earlier. It's really, it's accounting for specific and in many ways, sometimes restricted funding from like a grant that can only be used for this purpose, and capturing it in that fund and making sure all of the accounting is captured in terms of assets, liabilities, equity, and revenues and expenses in that fund. So it captures it and it isolates it in a way where you can go to that fund, see what's happened with it, and then also roll it up into a generally accepted accounting principle requirement and report that we usually see in our audit, or is what we see in our audited financials. Okay. Another difference between fund accounting and let's just say for-profit accounting is that at bullet point 2 here, we're stating that fund accounting is a system of emphasizing accountability rather than profitability. In for-profit accounting, you're really looking at net income and arranging your accounting system in order to capture how much profit you're gaining. In fund accounting and governmental, we're trying to achieve objectives. So it's not based upon how much cash we can keep in our bank account. It's really how much can we allocate our resources to achieve objectives of the institution, meaning graduation rates, retention, completion, enrollment, and things like that. Those are the things that we really are concerned about with our resources. We're not just in business to generate as much income as humanly possible. Say, for example, like how Walmart operates. It's very, very different, and there's a huge difference between fund accounting and for-profit accounting. A little diagram on how it all kind of works at a high level. The income is captured within our general ledger, and our expenses, of course, our outflows. Fund accounting, in general accounting, that's kind of how it happens. In fund accounting, our general ledger keeps the resources within that general ledger, and then our endowments are a separate thing that is a part of the college, but it's a separate almost entity that all of those income and expenses stay within the endowment. Same thing with our grants. Inflows and outflows stay within that grant fund, and so it kind of functions at a different capacity when you compare it to general for-profit accounting. A fund balance, you hear us talking about fund balances a lot, and what that is really your beginning fund balance that usually comes from the prior year. Then you add the current year revenue, and then you subtract out the expenditures, and then you subtract into a particular fund. You can transfer into a fund an amount that makes the fund bigger, or you can transfer out to a different fund transfers that make that fund that is the initial place of the transfer. When it goes out, it will reduce the amount of that fund. So that's kind of how it functions, and then you capture an ending fund balance amount, and that's what we kind of have been talking quite a bit about, is our ending fund balance for this fiscal year is higher than what we normally see.
Nick, the endowments in the last slide, is that essentially for us, is that the foundation?
That's correct. That's the
Okay.
foundation. So that's that kind of separate entity that it'll capture revenues and expenses in
Right.
there, but it's outside of these other funds like ING and grant funds.
Right. So essentially, for much of this discussion of fund and funding, that is outside, that's a separate entity itself.
Correct.
Okay.
All
Hey,
right.
Nick,
Yes.
this is Jody. Just a quick question to follow on there to George. With grants, the grant money, is it restricted? And do we know how much we get in grants and who gets them at the college?
Yes. And so the official restricted budget is really primarily grant funding. And when we report to the entities that we have to report to, And when we talk about restricted funds, it's usually grant monies. However, there's always like a caveat. I would also say that our debt service, mill levy revenues and expenses in that fund, those are restricted funds. There's a very specific purpose of what we can do with those revenues. And, you know, you can only use them to pay off particular outstanding bonds. So I would say those are restricted as well. But generally speaking, it's usually in reference to grants. Yes.
Okay.
And we do have that. We have all of our grants that that we capture, and we have to budget, and we'll present that to the board, not at today's meeting, but in the meeting on the 27th. You'll see that.
Okay, just a follow-on question. So do some of the grants go out to, I guess, some of the faculty? And then how do you monitor or assure that the college is meeting the requirements in those grants? And we can talk later about this. It's just an interest.
Yeah, so we have you know, some pretty substantial grants. Like the one that comes to mind is SBDC. So the SBA grant, PTAC grant. There's a lot of quarterly reporting that we have to do, and we manage that and make sure that we report back to our funding agency. And so that's one way we do it. What else? Sometimes we get, you know, during our annual audit, the auditors have to take a look at grants that are over $700,000. If the college receives more than $700,000 in grants, they will take a look at some of our larger grants that we receive, and they specifically audit those according to the specific federal grant requirement auditing procedures. So they take a look at those. Usually it's going to be, most of the time they look at student financial aid and the cluster associated with that, because it's quite a bit of money. And so they'll audit that every year. This last audit, they looked at CARES funding. So all of our CARES money, they took a look at that, and they were very impressed with actually how well our grants and accounting office kept track of those funds. And so that's kind of it. I don't know if I'm answering the question.
Yeah, no, that's great. Thank you. That helps me understand.
Yeah. Our grants there's really good accountability provisions that are in place with quarterly reporting, but then sometimes we get visits. We actually get visits from our funders, and they'll come on site and take a look at our grants, especially during the closeout and things like that. So there's a lot of eyeballs on our grants, and it's pretty onerous actually with what the grants office has to do, along with the PIs and everybody that's involved with them. Okay. Moving on, the components. It's a different way to look at the components, but you'll see in a very basic format, revenue comes into instruction in general, and then ING will normally transfer funding to other funds in the college, and sometimes those other funds can receive revenues in. So just a good example of that is Kids Campus. Revenues will come in for Kids Campus sometimes into ING, and then we'll move them over there into the to the Public Service Fund where Kids Campus resides. Kids Campus can also capture revenue for the services they provide, and they'll go directly into that Public Service Fund. So that's kind of how I think that's the point of this slide, is to show that you can capture revenue through ING into a fund or directly into that fund with this idea of fund accounting. Okay, let me see here. This will show you what sometimes keeps us up at night in accounting and budgeting. This is the way it really flows throughout all of our funds. You'll see the blue square there is ING, so that's the elements of Exhibit 10, instruction, academic support, student support, institutional support, and the plant fund or physical plant. And those are our operating budget areas that really perform the main functions of our college. So it's in other governmental entities, you would call that the general fund. In higher ed, you call it instruction and general fund. And so a lot of the funding will go into ING. And then sometimes you'll see at those white arrows there, we transfer money out. And normally we transfer funding out to public service, which is Exhibit 17. We transfer funding to student aid and grants at times, and then we will transfer funding to our plant and debt service fund in that plant. And debt service fund is where we'll have the policy requirement for cash reserve will be in there. And this year, we'll have some funding that is in excess of that cash reserve, so that we're going to ask the board to transfer into that plant fund that is related to a higher than anticipated closeout. So you'll see that in the future, where we'll have two amounts, one for the required cash reserve amount, and then another for an unallocated institutional reserve fund. Both will be located in the plant and debt service fund. And sometimes we'll receive some bond money, so bond proceeds that we will just book directly to plant. Those don't normally come through ING. We'll just book them to the plant fund in one fell swoop. We'll do that. Auxiliaries with the bookstore, normally functions and is able to identify and capture revenue that will just book straight to that auxiliary fund. Normally, we don't transfer money to the auxiliary fund, Exhibit 20, although we can, but we don't normally do that. And then student aid and grants at Exhibit 19, and student social and cultural at Exhibit 15, they will generate their own revenue through student fees that are paid when tuition's paid for. Those revenues will go directly to Exhibit 15. Again, internal services is the gray box there that you see. It's titled Exhibit 18, and it is the internal services where we have our OIT operations and our postage and our fleet and some of those things that are internal services. They get charged back to our ING exhibits throughout the year, but more importantly, at the very end of the year, we make sure that internal services zeroes out and gets applied back to ING. And those are just based upon the HED rules that really come from NACUBO, the NACUBO manual. Any questions on that? There's a lot of things that flow around within our financial system, and this kind of gives you an idea of how that all works. Okay, public service, I had mentioned that. Sometimes we'll transfer money into public service, Exhibit 17, which houses conference center. It used to hold the TV fund, but no longer does. We don't have it there anymore. We have Small Business Development Center. That's where the legislative appropriation, which is an RPSP, that funding does come to the college and ultimately gets transferred into Exhibit 17 for SBDC. And then again, Kids Campus is in there, and we will plan a transfer. Well, in the past we had planned transfers there. And Kids Campus also generates its own revenue from its own operations. Okay, student aid and grants, we transfer funding from ING into some institutional scholarships and dual enrollment. Auxiliary bookstore food services, we normally will have as I mentioned earlier, revenues from the sales there that go directly in there. It's not common that we transfer funding to bookstore and food service, but we have in the past. Internal services, and this is what I had mentioned, IT and mail and motor pool, fleet, copy center, and they get charged back to our ING elements there. Capital projects, state or general obligation bonds, local and state go into capital in the plant fund. Some state capital appropriation or revenue bonds, and any institutional reserve savings may go to the plant fund. Okay. So in terms of ING revenue, this is kind of the makeup of a little historical account of ING revenue from local appropriations. We had, seen in the past that kind of staying right around $20 million or so, and our state appropriation is a little bit smaller of the total of revenue that comes to the college, and that's at about, well, during this year it's about $5 million. So that's kind of decreased over the years. Tuition and fees has decreased recently, but you can see that it makes up that amount of right around $5 million. I'm sorry, I misspoke on state appropriation. It stays right around 10 million, and I think that in the new fiscal year 23 coming up will be right around 11 million from state appropriation, and then a very small amount coming from other sources. Our ING expense budget, and this is unrestricted budget, and it's just really important to keep this chart in mind, because out of all of our ING expenses, 75% of them or more go towards comp and benefits. Supplies and departmental expenses usually make up about 25% of all of our expenses in ING. Okay, last meeting, I was asked to kind of provide a little overview of mill levy and that revenue source to the college. It's probably at about 55% of all of our ING revenue, so it is the main source, and very important for the vitality of the college. The way the mill levy works is based upon property taxes, obviously. And on your property tax bills, you'll notice that you have two rates on there for SFCC. And one is for the operating mill, and the other is for the debt service or building. I think on the tax bill it says building maintenance or something like that, but it's really for debt service. And so those two rates are what you see on your bill, and that revenue that comes to the college for operating goes into ING, and the debt service goes into the plant fund. And it goes into the plant fund to pay off outstanding debt. And I'm trying to keep this at a real high level because it's a real tedious and technical calculation for how we derive our revenue from property taxes. But at a high level, really our mill levy rates are applied to the entire assessed valuation of property in the county. And from that, our mill levy rate gives us the amount of revenue that comes to SFCC for both operating and debt service building mill. In terms of assessed valuations, this is real critical to the calculation of revenue to the college. And assessed valuation of a property in Santa Fe County, as many of us know, it's about a third of the market value of the property, and that's the amount that shows up on tax assessments. You know, when you get your statement of it, your assessor statement that's showing you what your property is valued, it's a third of the market, and based upon, you know, the most recent sale of that property or whatever, but it's a third of that market value. And an example of this is, let's say you have a $500,000 property in the county, the assessed value would be a third, which would be about $167,000. And that 167 is what the mill rate is applied to in terms of deriving the revenue to the college. I mean, that's a real simplistic kind of calculation of it. When you aggregate all the properties in the county, that amount is 1/3 of what all the property is valued at. And then you apply our mill levies to that 1/3 assessed valuation, and then we can arrive at the revenue to the college. Operating mill levy revenue elements. So the operating, remember I mentioned there's two mill levies. One is the operating, the other is the debt service. So the operating mill is subject to this really complicated yield control formula. And so the amount of revenue each year is based upon, so the estimated amount of revenue to SFCC is related to our mill levy rate. And that mill levy rate is calculated using the prior year base. It's the amount of base assessed valuation for residential, non-residential, and state assessed property. So you get that base amount for those three categories of valuations, and then you apply the mill levy rate to that large number to get what is the anticipated revenue for the college. The base, this is a bit tedious here, but I really felt I had to put it in here. The base year mill rate, and so that's the mill levy rate for the prior property tax bill in the prior year. So that mill levy rate is multiplied by the total residential and non-residential assessed values. And that determines a pre-yield control revenue amount for SFCC. So when you basically multiply the mill levy rate for the prior year times the total amount of assessed valuation, you can get to that estimated pre-yield control formula revenue to the college. After that calculation's made, then you add in new construction and valuation maintenance. But the county comes up with, or the assessor comes up with valuation maintenance. Sometimes they'll increase the value of the assessed values, or sometimes I've seen it decreased. And of course that affects the mill levy rate and the revenue to the college. And once you add the new construction and add the valuation maintenance, you get the total new entire taxable value for residential, non-residential, and assessed property in the county. Then you apply this crazy growth control and yield control formula. And the yield control formula is really calculated to avoid large fluctuations of the mill rate to taxpayers. So it stabilizes that mill levy rate in the categories of residential, non-residential, and state assessed property values so that taxpayers aren't seeing their tax bills go like way up or way down. It stabilizes it in a fairly onerous calculation. And each year, the new construction in the county is really important because it provides more revenue. When you have new construction, it will increase the amount of revenue to the college. And it's also calculated with an inflation rate that we get from the New Mexico Department of Finance and Administration. And that growth control that includes the inflationary rate, it determines the maximum revenue to SFCC on that. And then the residential mill levy rate, the mill levy that's applied to property tax bills is calculated using what I was just talking about, the maximum allowable revenue. And it's based upon sort of the prior year numbers that add on new construction and valuation maintenance. And then it divides it by the total new taxable value of assessed property. And multiplies it by 1,000. That's just the calculation. The new mill levy rate is multiplied by the total new taxable residential property valuations in the county, and then divided by 1,000. And this results in the total amount of revenue to SFCC. But that's in the case that 100% of tax bills were paid. And that never happens. There's a certain rate for actual collections. And so when property taxes are paid, the county will only get a certain proportion of the collections of those tax bills that are paid. And that's usually for Santa Fe County is right around 97% of all total bills get collected every year. And so that in the calculation is known to be the historical collection rate. So what happens every year is you get, if 100% of all property taxes were paid, the college would get this much money. But we know that the historical collection rate is 97%. So we have to take that number of anticipated and expected revenue and then multiply it by 97% to get a more accurate projection of what we will receive. And the New Mexico Department of Finance keeps track of all of the historical collection rates for property taxes in all counties in New Mexico. And in particular, Santa Fe County usually has a collection rate of 97 to 98%. And that's a really high collection rate. It's really good because there's always delinquents. And if the county was only collecting, 85 to 90, that would really affect the college in terms of our revenue that we would receive for operating and debt service mill every year. And in the end, using the historical calculation rate for the county, the total amount of anticipated revenue for a year is multiplied by the historical rate times the new expected revenue amount for the college. And then that's where you get the total revenue to the college. So it's really 97% of what was billed out to property taxpayers in the county. So it's always a little bit less than 100%. Okay. And then the other component, so that was all talking about the operating mill levy that is applied to residential, non-residential, and state assessed property. The other mill levy rate that is on the tax bill is the debt service mill levy rate that I mentioned earlier. And revenue from the debt service on the tax bill, I think you see building on there, building levy, is very, 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 very restricted, and it can only be used to pay off outstanding local general obligation bonds and technology notes. The debt service mill levy is not highlighted and capitalized, not subject to that complicated yield control. And so the existing mill rate is really multiplied by the total new assessed taxable value divided by $1,000, and that derives the debt service mill levy revenues to the college that is provided to pay back outstanding debt service of outstanding bonds to the college. So you get the debt service mill levy rate, and you just apply it to the base assessed property valuations plus the new construction plus any valuation maintenance, and then that total amount divided by 1,000 gives you the revenue to the college. And then also the historical collection rate for the county is applied to the debt service mill levy calculation. So if 100, if the county submitted bills to all of the outstanding property, we would only anticipate getting 97% of those bills paid back. That would be revenue that comes back to SFCC. Oh, any questions? Sorry, it's complicated, but I hope this kind of gives you some insight on what goes into the mill levy rates. The main thing to take away is what you see on your property tax bills is for operating mill levy, debt service mill levy. Operating is subject to yield control. That calculation keeps it from fluctuating, down, and then taxpayers having to see a major increase in tax payments. It really, the yield control levels it out, and it's based upon a growth factor related to the new construction in the county and also inflation. And that's it in a nutshell. Does that help, Jody? I hope I didn't confuse you more.
Yep, that was perfect. Thank you, Nick.
Okay, I'll send this out to you so you all will have this slideshow.
Good.
Okay, moving on, we're almost done. On the expense side, I was talking about revenues. On the expense side, you see how we have our current fund, and the current fund again is the ING fund, exhibits 10 through 14, that's ING, and current funds that includes public service, as well as internal service, as well as auxiliaries. So all of that together is current funds. And ING makes up a big proportion of that. You can see from this diagram how compensation and benefits and non-personnel, which are departmental costs, are structured within each exhibit and the makeup. So just for exhibit 10, instruction in general, instruction, compensation in the orange color, it makes up the large proportion of expenses in that exhibit. And then you can see the other ones. Moving
So
on.
non-personnel, for example, in instruction would cover what, equipment or?
Yeah, travel, supplies expense.
Okay.
Anything else, Amy, Tilly, that comes to mind there? It's really mainly travel and supplies expense.
That's basically it. That would go in there. And no supply expenses would be whatever's needed for the classroom and stuff like that.
Right.
And then this is an incredibly important chart here, because This really shows the need for that $12 million in reserved cash. Look at the months of February, March, April, May, June. Those are the months where, let's see here. I think I'm missing a couple of, yeah, that shows you what the colors are indicating. So the darker blue is the cash inflow. So that's actual cash coming in that month. The reserves is the blue area of the bar. And so that's what we have in the bank account, but it's sitting as reserve. And so the cash inflow is kind of our annual resources that we're looking at. And you'll see at February, with respect to the expenditure line, that expenditure line in February, it really meets the amount of cash that's coming in. So expenses and cash in are kind of balanced out. But in that very next month, in March, the actual cash coming in is much lower in that dark blue colored bar as compared to expenses, when you have those obligations in expenses that occur every month in a certain manner, and your cash inflows are not meeting what the level of those expenses are. So that means we're living off of our reserves. And so our cash reserves and our cash account helps to provide the cash flow to meet those obligations. If you didn't have the reserves, we wouldn't have enough money in March to pay the expenses. That's really what that's saying. Same thing in May. Our inflows of dark blue inflows are much less than our expenses in May. So we're supporting the expenses with the reserve amounts that are sitting there. And then in June, it catches up just because of the timing of when the college receives its mill levy funds, right? Mill levies are paid in May and June. That's why you see it increasing there. And then those infusions of mill levies last through July, August, and September, and in October. And then in December and January is when we get most of our mill levy revenues. That's extended a little bit more to February as well, but December, January, and February is where we get the large infusion of our mill levies that provide a lot of annual cash that has to remain in place to support the college through the other months of the fiscal year. But you'll see there that, if it wasn't for the large infusion in December and January, we really wouldn't have much cash to be in place to fund expenses through February, March, April, May, even June and July. And so that's why that policy requirement of having percentage of expenditures that are in cash reserves that exists all the time, it helps us with this cash flow problem. And it will help us to avoid what we experienced, 6-7 years ago. Where the cash, go ahead.
Yeah, why is it that we get such a, it is so uneven? Is it because the city also gets it in a uneven fashion?
Yes, because property taxes are paid twice a year. You get your tax bill. And people can elect, they're gonna, if they want to pay
monthly, right?
Yeah, monthly, or they could pay it all in December, and then that's it. But some people elect for first half in January, December, January, first half, and then in May, June, second half. Some people have elected to pay it monthly too. So, but the large amounts of revenue from mill levy come in at December, January, February.
Right.
And since mill levy makes up such a huge proportion of the resources to the college, that infusion has to last throughout the year. And so having a good cash reserve balance helps to be able to have enough cash to support the college when we have low revenues recognized in particular months during the year. And that is it, I think. Okay, so any questions on our budget review?
I'm sure I'll have lots of questions when I sit down and start looking at these charts again, but at the moment, I don't have any. Any other questions, comments?
Thank you, Nick.
Hey, thank you all for
Okay.
bearing with me through that. A lot of tedium, but it's important.
Okay. So our budget training is complete. We will now move to action items. And once again, Mr. Tellis and Ms. Tilly, please take us through the various action items.
Okay, we're going to start out with, we're here today to ask the board to approve a budget proposal. But one thing that has to happen kind of in the order of operations is the compensation schedules. And so I'll bring those up here and share them with you. So we're going to ask you to approve the compensation schedules that have been revised for FY22 and FY 2023. We're really asking the board to approve the FY 2023 compensation schedules, and we're intending to implement those at April 1. That would be applied to all of the college, however, not the bargaining unit of the college. Those have to be determined within negotiations, obviously. So let me pull up this screen here. This year, as we all know, has been an incredibly different budget year. And that's because the legislature, during the session that went from, what was it, January to February, governor signs off on legislation by March 9th. That legislation required the college to implement a 3% compensation increase for the fourth quarter of the current year we're in, fiscal year we're in, FY22. And then the legislation requires that 4% be implemented at July 1 for the next fiscal year, FY23. The legislation requires a $15 an hour minimum wage for all higher education institutions in New Mexico. And so within these salary schedules that are in your packet, we are implementing the $15 an hour minimum wage, which it has an impact with pay compression at our institution, because in the past the college was following the county's minimum living wage, which was it was imposed at $12.32 an hour. So when you move those employees from $12.32 an hour to $15 an hour, that is a legislative statutory requirement that we have to do. And what that does is you have employees that were in and around that $12.32 level that are now going to be at $15 an hour. In the past, you had employees that were in higher level salary grades that were at the $15 an hour amount that need to be moved up because now they can't be at the minimum wage requirement. So with all that said, we've adjusted the staff hiring matrix and salary schedule to be able to accommodate the $15 minimum wage as well as an 8% aging of those schedules. And that's what's in the packet. We can walk
Just a
through.
quick question on that.
Yes.
So how many employees are below 15 right now? Do you have any idea?
Approximately around 100.
Uh-huh. And just to clarify, we're giving them 15 plus 8%?
No, what we are doing on them is that our starting wage will be $15.15 for regular employees.
Yeah, let's
So
go to that.
Workers will
let
be
me-
at 15 and regular staff members will be at $15.15 to start with.
Oh, I see, the different ranges. Okay.
Yeah, and Madam and Member Siegel and Mr. Chair, we did the 15-15 because we plan to start the student employees at 15 to include them in this, and we just felt that it would be more equitable to have our salary grade start for custodians and those categories of jobs at a bit higher than what the student employees are making. So that's the idea behind the 15-15.
So
So then-
the adjustment for people who were making $15 an hour, what are they now making?
Amy, do you want to take that?
Yeah, I'd rather try. It's all tiered based on the different ranges, the pay bands. And so they've all gone up. So like
Right.
the custodians used to be at on average around $13 an hour. So the custodians are looking at going up to $15.15, which is approximately like 18% increase for them. And then the other pay bands are also increasing respectively. And so that's why you're seeing we are now going to a set hiring rate for grades 7, 8, and 9, and 10. So there is no longer a range in those. It's just a set hiring rate range in those. And then you'll see in 11 and 12, that's where we will go back to having a range in there. And so what's happened is one of the things we paid a lot of attention to was where an employee's, it's called penetration, where their penetration is in their pay band, and making sure where they were today on the current wage scale and where they are with the new wage scales stays relatively the same, so they don't lose their placement within their pay band. And so I wish I could give you a really quick answer on it, but there's a lot of variation on how much the increases are in those entry level pay bands, because we're accommodating the $15 an hour starting wage. And then we're also making sure we still have the hierarchy in the structure. And we're also making sure we didn't have pay compression in there too. Anyone that's in basically the bands 14 and below, which is where you're starting to see your paraprofessionals and up in there, they're all easy and at 8%. But it's those entry pay bands where we had to do some different changes in there. And on average, they're above 8% in those bands because of trying to address this big increase on the starting wage and maintaining the structure.
So, okay. So the midpoint and the maximum on 11 and 12, for example, does that have to do with years of service?
It does weigh into that. It would be basically on their credentials of what education that they have, and also how many years of related experience that they would have related to the job that they would be looking at. So it does have a factor in that upon hiring and the salary determination.
Right. Okay. Okay, thank you.
Thank you.
Okay, so that's covering the staff salary schedule, and we're intending to implement this by April 1st, which is already passed, but we'll be able to meet the legislative requirements that asks us to put this into place April 1 and have it into people's basically paychecks by the first pay period in April.
So for just to clarify that, so because we have two different pay cycles happening for hourly and salary. For the salaried folks, we'd look at this pay increase being included in the April 8th paycheck. And for hourly folks, they would see it in the April 22nd paycheck, but they both have the same effective date, but it's just because of the way the pay cycles work. The hourly folks have a week lag in what they're paid out on. So that's why there's a difference on that. And then also I wanted to clarify, because we did bring up the words, the pay schedule for students, which is on the miscellaneous schedule. And I don't know, Nick, if you'd like to turn to that page. That one, as you can see on there, all the on-call temps and students, their changes would become effective July 1st of 2022, not with the April 1st. It's just, that's the one that'll start with July 1st. Thank you.
And Amy, we also have increased the maximum dollar amount for the miscellaneous wage schedule from $30 to $32 there. Any questions on miscellaneous wage schedule?
No.
Not a lot of changes here on this one. In terms of the adjunct faculty salary schedule, Margaret Peters, are you there? Could you just give a little background on your work with the adjuncts on this?
Sure, I'll be glad to. We've worked pretty closely with Craig Donaldson, who initially brought up the question and concern about whether or not we would be able to consider increasing the adjunct faculty salary schedule number of steps, because it had 7 steps. And you'll recall back, I don't know, in 2014, I think the full-time faculty schedule increased to 10 steps. And so after some kind of discussion and deliberation and number crunching and such, what we've done here is we've aged the matrix, of course, the 8%. We have also added an 8th step. And this is with an eye toward raising this matrix 1 step per year until we reach 10 steps. I realize we can't predict the future right now, and we've been super clear with folks about this, but I just am mentioning this in terms of our hope. But we have added an 8th step in this schedule, which is 1 more step than there was last year.
Yes, this will be effective with the summer semester contracts.
Yes.
And also, it has been aged with the 8% in here, adding the 8th step, I believe.
Could you please describe what those numbers are? Teaching
Yes.
experience, 0 to 12 and 85 plus, are those years, days, months?
It's credit hours. And so this is number of credit hours that you've taught at Santa Fe Community College. And so each semester, board member Gamble, Chair Gamble, when we have adjuncts come on, that is on a semester basis. So whether it's the fall, spring, or summer session, when we are putting the adjunct faculty contracts together, we place any given adjunct wherever they belong on this table. So it's according to number of credit hours they've taught at Santa Fe Community College, and then also where they are in terms of degree. And that's how they're placed on that
Right.
schedule.
Now tell us what the numbers are in the other cells underneath each of the degrees.
Those are dollars. So
Those are
$808 at step 1 under the bachelor's, and $825 under step one for the masters. That's money. Mhm.
Okay, thank you.
And that's per credit hour, or per pay hour, I should say. But
Okay.
yeah.
Thank you.
Sure.
Any other questions on the adjunct faculty salary schedule? Okay, so then that leaves, a couple more schedules. We have here the non-collective bargaining unit faculty salary schedules, and for both 9-month and 12-month. And ultimately, a couple of things have happened here where these schedules have been aged 8%, and at the step 1 and 2 of the MA plus 45 for 9-month faculty, that's been adjusted because there was a real strange anomaly there where the difference between the step 1 and step 2 for MA plus 45 was much lower than the higher level steps. And so we intended to correct that. And now everything in there is what, Amy, 2.4% from in between step 1, step 2, and subsequently for all the other steps down the scale through step 10. It's
On
about
the
2%.
MA plus.
Yeah, on
Yes,
the
it's
MA plus. So we've just rearranged that to accommodate that correction, if you will, between step 1 and 2 on this schedule.
And what is the MA plus 45 what? Credit hours? Okay,
Go ahead, Margaret.
Yes, that's correct.
thank you.
Mhm.
Any other questions on this non-bargaining unit faculty schedule? Okay, and this is a huge win for our college. I'm so happy we're able to put this in place. Amy, Tilly, go ahead and walk us through. This is a schedule for Kids Campus, and using our staff matrix, which we had done in the past, just was not working for us well. And we needed to really be able to create a salary schedule for our Kids Campus that is accommodating to the state requirements out of the early childhood and care department. And then just with our simple, just the functionality of how things happen at Kids Campus. Go ahead and walk us through here.
So yeah, this was a result of a lot of collaboration with the Kids Campus leadership over there to come up with a way that we could handle better for them on getting the teachers in and having them come in by rank based on their credentials that they have. And then also working in background to make sure that's kind of within our existing pay structure. And the best thing to do for this and to accommodate this was to create a standalone pay schedule. So this is the first time we've ever had this pay schedule standalone. We may have had one many years ago. I found a little trace of one, but this is the first time we've had this, at least in the last 5-6 years. And so what this does is it really just creates an established pay rate for if they're coming in, for example, if you're a teacher and you're going to be at rank number 2, that means you're coming in with an associate's degree in early childhood. And you've had 2 years of experience in a childhood setting. And so the salary would be $45,760 for that person. There's also a ranking for the teacher assistants too. And once again, that ties to their credentials and their education. This will really expedite things for them because we no longer have to spend the time doing salary determinations. It'll literally be just about looking at that person's credentials and then matching them up with the right rank that they would be coming in at. So hopefully this will expedite some of the hiring process for them. And then also this gets them really right there on current with the market rate for teachers in daycare settings. And also teacher assistants, sorry. It's more than just the teachers, the teacher assistants too. And this one becomes effective with April 1st.
And Mr. Chair, that covers all of the salary schedules that apply to meeting our legislative requirements of making things effective April 1 in the fourth quarter of this year, and then the new FY23 new fiscal year.
Okay, great. Thank you. Questions? Any other questions from board members?
This is Jody, Chair. I don't have any questions, but I just want to say good job. Looks like a lot of work went into this, and I'm really, really happy about the kids' campus.
Great to hear. Yeah. Yeah, Amy Tilley worked a lot with the college and spent a lot of time, because this was not easy to do with the legislative mandates because of that. You have to basically rearrange all the schedules to accommodate the 15 and then the pay increase.
Okay.
I have one question. So in the staff salary matrix, so the people in the 7, 8, 9, 10, so those people get hired on at a rate, and besides legislative raises that we get, every custodian, no matter how many years of service, just all get the same rate?
Yes, they will on those. There's a couple of, in some of the other, like 10, I have some people that are going to have to be grandfathered in just because they didn't fit quite right. I only have 3 people that are just not fitting quite the right. And that's just because they've been here for long. But all the custodians going to 15 is giving them all more than an 8% increase. And then this also ensures that we have the same pay for the same type of work, which is another thing that's really important to us. And, that's once again dealing with the equities and always keeping an eye on that and making sure that we are right on board with that.
Okay. Additional questions? If not, I'll entertain a motion to approve the compensation schedules.
I move we approve the compensation schedules.
I second it.
Approved and seconded. All in favor, please indicate by saying aye.
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 3, 4, and aye. Moved unanimously. Approved. Okay. Nick, approval of the budget adjustment request number 1.
Okay, so this budget adjustment request number 1 is for the current fiscal year we're in that goes through June 30th, 2022. And in here, what we have proposed to the board is, let me see. This would implement the compensation schedules that you just approved, and it would, for the most part, implement them at April 1 for this current fiscal year. And this is the budget that results from those changes. And you'll see here that in our proposal to the board, we're talking about, it's quite an interesting effort here, because in order to figure out this current fiscal year, and because we're talking about expenses related to the legislative requirement, that impacts our future years, right? And so that's what this schedule here is kind of showing. What we're asking the board to approve is the light green column titled FY22 budget bar number 1. And you'll see in there that the revenues anticipated changed from our original budget by almost $800,000. In particular, local government appropriation, so that's mill levy, has been revised upward by $742,000. And that leads us to this total budget adjustment for revenue of 38,901,459. And that, again, that is about $800,000 higher than what we thought in our original budget. On the expense side, expenses are just being reduced down slightly so that we can identify and forecast a better ending fund balance for this fiscal year. So with the way things look on the expense side, we're revising our expenses down from the original budget of $36,052,821, and that is going down about $836,000 to a new expenditure amount for our bar number one in the amount of $35,216,738. With that, we will have a net of revenues over expenses of $3,684,721. And then you have to take out the transfers that are related to our other current funds and transfers out of the ING fund. And that after you do the transfers, you have a total net gain of $927,923. When you take into consideration our beginning balance for the year of $8 million, what we're asking the board to approve is $1,500,879 to be transferred to our policy requirement for cash reserves to get us to the level of what our college policy requires. Because we have a higher beginning fund balance and larger ending fund balance for this fiscal year, we have identified that we're going to have $6,464,843. That is in addition to the cash reserve requirement. And we're asking the board to approve that to be transferred to our unallocated plant fund to sit as an excess reserve amount in order to fund our compensation increase in future fiscal years. And so really that allows us to achieve the mandatory legislative requirements along with our HED requirements for reserve ending balance in ING for the current fiscal year. And while doing so, we'll make an 8% increase to compensation for budgeted positions that would be effective April 1 under this budget adjustment request number 1. Amy, Tilly, do you have anything to add on to that? Did I miss anything?
And why is it called the budget adjustment request number 1? Are we anticipating another budget adjustment request for this year, fiscal year?
I don't think we will be, but we possibly could, but you do have to number them because you do have the option of doing multiple a year. And so HED just requires us to number them. And this is the first one brought to the board. So this is number 1. And as we finish doing the wrap up and closing out the planning on all of this, when we come back on the 27th, if I have to do any cleanup, then I would bring in number 2 to do any cleanup. Because as we talked earlier, this has been very expedited, making sure this all happens.
Okay.
And so, but yeah, so normally it just has to be numbered and hopefully it's a one and done. That's my plan.
Right. Okay.
And Mr. Chair, if I could just add on for the record, that this increase of the 8% that achieves the legislative requirement, it has a cost for this fiscal year of a bit over $600,000. The legislature provided us with about $175,000 to fund it. And so the remaining balance there is going to come from expense savings and mainly expense savings, and also this adjustment that increases our revenue for the year. And so I
Right.
just wanted to point out to the board that the amount for the increase during the fourth quarter of this year is a bit over $600,000, but we have enough resources to make that happen. And then that increase, when it happens at April 1, it rolls into the new fiscal year for FY23.
Okay, good. Thank you. Okay, if no more questions, do I hear a motion to approve the bar number 1?
Approve bar number 1.
Okay,
I second it.
second. All in favor, please indicate by saying yes.
Aye.
Aye, yes.
Okay, yes. So we have unanimous approval of bar number 1. Now for bar number 2. No, not bar number 2. Tuition and fees for fiscal 2023.
Mr. Chair, board members, President Rowley, this is an item that we're required to have the board approve every year. And what management's recommending is that we maintain that plan and implementation of having tuition and fees for the number of credit hours between 12 and 18 credit hours remain flat, as we did for the current year, academic year that we're in. And we're also recommending that the governing board does not increase tuition and fees for FY23. These amounts that you see in your packet will be the same if the board approves this, will be the same for the next academic year that we have in place currently. Tuition and fees are not changing, both categories. That's it.
Does this mean that in the spring of 2023, like a year from now, we would review the budget again, and if necessary, we would increase tuition and/or fees at that time?
Probably for FY
For the fall.
2024. FY
Or for the fall of 23? Maybe.
Fall of 23, yeah, correct. Maybe.
Okay.
We have to do this every year, and this is huge for developing our entire budget for the next fiscal year. So at this time next year, we'll reconsider tuition and fees and go through that process again.
Right. Any other questions? Hearing no questions, I'm listening for a motion to move.
So moved.
Second.
All those in favor indicate by saying yes.
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 Yes, pass. Okay, unanimously approved. And now we go to the operating budget for fiscal year 2023.
Okay, Mr. Chair, board members, and President Rowley. Hopefully you were able to take a look at the memo that we've included in your board packet, which kind of explains the budget impact related to our legislative outcomes. And again, as you have included in the bar number 1 for FY 2022, that decision that implements a 8% pay increase for budgeted positions at April 1, that 8% applies to FY 2023 and will continue into the upcoming new fiscal year. And as a reminder, I've probably beaten this horse to death here, but the legislature required a 3% to be enacted in the fourth quarter of the current fiscal year, and then 4% to be enacted at July 1 for the new fiscal year, FY23. By implementing 8%, we're doing both of those actions at one time. and making that happen in April 1 to accommodate the requirements. And the other important things is that is integrated in the FY23 budget. And this cost will, this will cost the college in FY23 about $2.7 million, a little over that. The legislature has funded us about 1.2 million to cover the 2.7. The remainder will really come from that amount that the board approved to be transferred to our unallocated funds in the amount of 6.4 million. Some of it will come from that. Some of it will come from new revenues related to our mill levy funding. And with that, we've been able to put a budget for FY 2023 that accommodates that 8% pay increase and meets legislative requirements related to the $15 an hour minimum. You approve the salary schedules that are required to make all of this happen. And so with that, I can stand for any questions. I don't think we need to go through the detail of the board packet, but I will
I have a
ask.
question.
Yeah, sure.
Linda. So the legislature always underfunds us when they do mandates of their percentages. So if we were just going with the mandate of the legislature, how much underfunded are we compared to that 1.2 million? How much more should the legislature have given us for making sure all of our people get that salary increase they want?
Good question. Let me do the.
I always like to remind them that they never fund us sufficiently.
Let me crunch a number real quick.
Board Member Siegel, we have done training with DFA. Well, when I say we, Kathy Ulibarri has done training with DFA in the last few years to try to explain the way that the underfunding works. And I thought we were kind of getting somewhere until C&M hired the former cabinet secretary to work for them. And now that doesn't seem to be having any traction.
And of course,
Well,
LS always wants to underfund.
Yes, and we brought them in, it was really good training, and I think that people learned a lot from it, but they still rely on the story that we can raise tuition to make up the difference.
And then criticize us for raising tuition.
Right.
Yeah.
I would say with high level, unless Amy, you have a better number, a high level number, rough estimate would be about 1.2 million that's unfunded.
Wow. Almost double. Well, double. Well, a little less than double.
I think the less mill levy that you have, the more they are the higher percentage of the raise that they fund. But for the most I've ever seen is, maybe it's somewhere around 65 to 70% of it or something. But for us, it's pretty low.
But so where are the details then for that? Because in House Bill 2, they just put a number amount, like 600 or 69 million for higher education salaries. And then does DFA decide how to appropriate that based on mill levy?
I think so.
Ah, okay.
In those details, I can ask. I mean, we might be able to get them, but I don't know. Nick, do you get that routinely?
A lot of it is coming from, they're looking at what percentage of our ING revenue the state appropriation is. And
Right.
because our ING revenue has so much of the local appropriation, so they have basically, I think they're at about 40% of our ING revenue is what they're looking at. So that's why they are working with those, that's what they're using as their driver to what part of us are they responsible for.
That's right. And then, a place like Mesa Land where they have, 1% of the levy.
And they'll never do much better even if they raise it to 5. And so they will get more.
And in your board packet, you can see all the state documents that were included. They do have a yellow background on them, and that was to let you know they came directly from the state. And so that starts on approximately page 12. Just to give you guys, I always like to give you the backup, and
Oh yeah.
and so you have all that. So in case you're really bored one night, you can work through that. And
Oh, yeah.
and if you ever want to talk about the details of HUD math, I've become quite obsessed with it. So I would love somebody to talk to about it, because it's ooh. No one wants to talk to me about it though.
So you mean I can call you right after this meeting? And
You got it. And I'll walk you through it, and we'll just have the best time.
Okay. Any other questions about the operating budget? No questions? Okay. Could I have a motion to approve the operating budget for fiscal year 2023?
Move
So
to-
moved.
Yep, second it.
Okay. And all in favor, please indicate by saying something.
Aye.
Aye.
Okay. I hear approval. Entirely unanimous approval. Thank you very much, Nick and Amy, for taking us through this. Very, very complicated. And I must say that I really appreciate the projections. That really helps me a lot to see, okay, if we do this, what's it going to look like in the next few years? Again, understanding that there's uncertainty, but still, based on what we know now, what's it going to look like? Very reasonable projections. We can change them because we can have as many bars as we want, right?
We can. We can go to the bar as often as you would like.
Okay. Thank you very kindly. Okay, our last action item, approval and endorsement of a proclamation of Community College Month. Dr. Rowley.
Thank you, Mr. Chair. I'm going to ask Laura Mulry in a minute to share a copy of what we've proposed for a proclamation for Community College Month. And what this does is highlight the importance of the community college mission and the work that we do in our community. What we'd like to do is to take this proclamation to the city and to the county and ask them to support it. It's kind of a lot of community colleges do this to try to raise awareness for the mission of the community college as a separate entity as opposed to the mission of higher education in general or four-year college. So our marketing staff put this together. I think they did an extremely nice job doing this. It is sort of a follow-up to the op-ed that you wrote and that was published in the New Mexican yesterday, to again to show the differences and some of the distinct features of the community college mission. So I will ask Laura Mulry to, Laura, I don't know if you have any further comments about how you guys put this together and everything, but I think it's short, sweet, to the point, but covers the main features.
That's right. Thank you, President Rowley, Chair Gamble, and members of the governing board. Our goal here was to highlight how different a community college is and how much we are integrated into our community and the things that we do for our community, and also that we're grateful to the community for supporting us over all of these years. because without the support of our voters, of course, we wouldn't exist, and the legislature. So it's brief, but we thought this would be a nice addition to the events, activities, and Dr. Gamble's op-ed to promote the college this way with a formal proclamation, which of course we would also post on our website. Does anyone have any questions?
Could you roll that down just a little further so we can see the, there, that's good. Proclamation 5418 establishing that, wow. And that's, wow, the President of the United States, that's 5,418 of the President's proclamations. Okay.
I believe that was President Reagan.
Oh. Wow.
So there is a federally designated community college month, among other things. And you know, we, our intent this year is to begin recognizing that with more deliberate attention to that, with more targeted advertisement to our students, and by bringing this proclamation to the city and the county, really by eliciting their support in a little bit more direct fashion right now.
Right. Well, it looks great. Thank you very much for doing that. And I will entertain a motion to approve this proclamation.
So moved.
Second.
And all in favor, please indicate by saying something.
Aye.
Aye.
Good. Unanimously approved. Thank you very much for doing that. We will look forward to seeing that on all over the place.
Thank you.
And I believe that concludes our agenda for today. And I will call for a motion to adjourn.
So moved.
Okay. Do I hear a second?
Second.
All in favor?
Aye.
Very good. Thank you very much. Long and tough meeting with all those numbers, but I think very, very valuable for us to look at those numbers and think about ways to keep the community college viable in our wonderful faculty and staff with us as well. Okay, thank you all very much. Meeting, yes.